Good evening, everyone. Thank you very much for joining us this evening. We appreciate you taking the time to join us. We received a number of inquiries after the most recent city currents, and we were fortunate enough to schedule Mr. Giron from the FEMA office, Region 6, to come out and give us a talk on the introduction to the risk rating 2.0. At this time, Mr. Giron.
Good evening, and thank you for the invite to speak on Risk Rating 2.0. My name is Gilbert. I'm the Regional Flood Insurance Liaison for FEMA Region 6. My position description is to reach out to any of our insured, or for them to reach out to me if any questions that they may have in regards to their premium, any delayed in claims, any delayed in increased cost of compliance. It's my job to take those concerns and see if I can bring them to a resolution. With that being said, I've also been brought into and allowed to speak on what is Risk Rating 2.0. And Risk Rating 2.0 is a major change on the way we are going to write flood insurance. And I do have a very powerful presentation. This is a reduced presentation. The actual one is over 5 hours long. They couldn't give me 5 hours today, so I kind of condensed it down to almost 50 minutes. And of course, we will be open for questions and answers afterwards. However, I do ask that if you have any address-specific questions, you reach out to me on the side. I don't have access to pulling up any information right now, so I really couldn't answer any questions if you have address-specific. But in general questions, I can do my best. Okay, so before we start into Risk Rating 2.0, let's talk a little bit about our numbers right now under the NFIP. Right now, we have about 5 million policies in our book of business. Now, that is nationwide. So as you can imagine, FEMA cannot write 5 million policies on our own. So we rely on partners. We call them Write Your Own, or WYO partners. Those are your major companies. We have over 62 in cooperation with us right now. Now, they write and they maintain flood insurance policies on our behalf. Currently we have almost about $1.3 trillion in total coverage out there across the nation, quite a few. And we have 22,525 communities who participate in the National Flood Insurance Program. This community is one of those. Participation in the National Flood Insurance Program is voluntary. It's a quid pro quo program. The community agrees to adopt and enforce floodplain regulations. In return, affordable flood insurance is available, as well as access to grant monies and other benefits. I wanted to go over some numbers. I know there's been a lot of rumors about Risk Rating 2.0, but this is what we have, okay? Right now, what we call preferred risk policies, they were the lowest of the low. They were the best product we have. And in order to be eligible for a preferred risk policy, you had to be outside of a special flood hazard area known as the X zone, which was the area of minimal flooding. As you can see from the box, we had about 49% of our entire book of business for single family homes of PRP policies. That was quite a few of them. But unfortunately, the preferred risk policy product is going away. And let me explain why. Before, the PRP was based simply on its location on what was called a flood insurance rate map. If you were outside of a special flood hazard area, you had no other eligibility requirements preventing you from getting a PRP. You were rated based off of a schedule for that. There was no risk assessment based on these policy numbers. So you could be right across from a bayou outside of the special flood hazard area, and you will be rated on a PRP policy. We took that in consideration when we developed Risk Rating 2.0. Now, the thing about Risk Rating 2.0 is we are now going to go off the individualized risk assessment for every building in our book of business. So with that being said, we're no longer going to be looking at the individual flood zones that we have known since the inception of the National Flood Insurance Program since 1968. So we'll touch more on why preferred risk policies are going away, and the individual rating variables are going to be taking its place on determining the flood insurance cost. Another number I would like to bring your attention to, if you look at the gray box in the center bottom, you see grandfather properties. Well, grandfather properties are going away as well. Now, if you'll notice that there's only about 165,000 of them, and once again, that's nationwide. So in the grand scheme of things, based out of 5 million, there's not a whole lot of grandfather policies going away. Now, that doesn't mean if you have a grandfather policy, it just stops. What it means is that your grandfathering rate is going to be your starting point under Risk Rating 2.0. And then if your risk rate, your full risk rate is higher, you will be on an incremental increase of 18% until you hit the full risk rate. So grandfathering is still going to be beneficial. The name grandfathering just will not continue forward under new policies. So risk rating 2.0, it was implemented because in the 1968, when Congress implemented the National Flood Insurance Program, we were required to have a sound financial floodplain management program. We have a scope of authority, which allows us to make changes. Everything under risk rating 2.0 was under our scope of authority, so we did not have to ask Congress for any changes. With that being said, there were some statutory programs that were implemented by Congress, which we could not change. Those are the pre-firm subsidized properties, and those were the newly mapped properties. Now, the equation on how they are determined is changing a little bit. It's going to be based off of a percentage of the first 35,000. They're going to be reviewed annually by FEMA to determine that exact percentage discounts, but they will stay in place. We have coastal high-risk properties. If you take a look at that, you'd be kind of surprised. We have about 12,289 of V-zone coastal properties. Not a high number, but as you can expect, the average premium for those are pretty considerable considering the risk of not only flooding, but also surcharge and wind action. It was about 5,470. But let's talk about the one in center, full risk properties. Of all the properties we have about 28.8% of those in our book of business. These are full risk properties. That means they're most likely post-construction and they have very good data on them, right? So the individual risk assessments are going to impact them differently than structures such as the preferred risk policies, which we did not have post-construction data. We did not have good risk analysis data on them. So those properties are going to see less likely of an increase than those that are based off of unknown assumptions. So risk rating 2.0, the full name of this is called risk rating 2.0 equity in action. Now, under the old program, what we call the legacy program, we inadvertently made a mistake. We inadvertently put in position where lower valued homes would eventually subsidize higher valued homes with rated premiums. And this was because we just rated them off of the flood zone, the base flood elevation, and their elevation of the surrounding area. So what we were seeing is that you would have a house side by side, one house valued at 200 or 2 million, another house valued at 200,000. With all other characteristics and consideration the same, their flood insurance premium would be the same. Even though we know that the $2 million home would experience more damage and cost more to repair than the house valued at 200,000. So in essence, we had lower valuation homes subsidizing higher valuation homes. So risk rating 2.0 equity in action is fixing this. Now you have a lower, if the cost for a home has a lower replacement cost value, you can expect a lower premium than a house that has a higher replacement cost value. We are fixing the errors that were inadvertently put into place under the legacy system. Because of this, roughly 2/3 of the policyholders with older preferred homes can experience a decrease. Now, this is nationwide, not state-specific data. Water does not stop on a flood line. What we mean by this is that you can have a flood zone, as this slide deck indicates, we have an AE zone. Then right when that dotted red line stops, outside of that is an area of minimal flooding. Well, we have been through some things down here, Hurricane Harvey, just to mention a few, and we have learned that water does not stop because there's an imaginary line on a piece of paper. Okay, so those are our rate cliffs, what I was talking about. The flood premiums inside of the AE zone were significantly higher than those were out. But those that are out, we have seen 33% of our claims in these areas that have been deemed areas of minimal flooding. And on top of that, they are partial claims. And they are, lack of better terms, they're eating our lunch. These partial claims are costing millions upon millions of dollars because these houses, remember, are not based on individual risk. Their premiums are simply based on their location on a paper map. So risk rating 2.0, we are going to change that. So this is also the point in time where I tell you a little bit about why it's so important that we are changing from the legacy system to risk rating 2.0. I've already said it a couple of times. This program was created in 1968. It was meant to be a self-sustaining program. We collect the premiums. We use those premiums to pay out the claims. Well, 2005, we had some significant events. We had Katrina, Wilma, Rita. That year alone, we've had over $17.5 billion in claims. And then we have seen an increase in severity of events year after year. This is the 6th consecutive year FEMA has paid out $1.2 billion in claims. We are hemorrhaging money. This program, as we had it before, was not sustainable. We had to make changes. Now, I understand some of these changes are going to impact people in a negative way. Well, my personal opinion is we should have impacted these changes many years ago. This program has been in implementation 54 years. And we're still writing flood insurance based off of 70s methodology. We are now coming in line with current industry practice, where you're incorporating industry catastrophic modeling. We have procured products that will help us write flood insurance based on individuals' risks. We are coming into the modernization of how flood insurance is written through the NFIP. And I'm going to start by a couple examples under the legacy system. Remember, the legacy system, what we're referring to today, is the old system of what we use to write flood insurance. As you can see, the rating variables, we use the flood insurance rate map, we use the base flood elevation, the foundation type, and any structural elevation if it applied in the special flood hazard area. That was it. Those were the rating variables we used to determine the flood insurance premiums. And as you can tell, they're just a few. Now, in modern times, we have now experiences in flood perils that can impact houses differently. And no longer is the case where one house can be impacted by just one peril. One house can be impacted by 6 different perils if it's in the, I would say, right location, but if you're impacted by 6 perils, it should be the wrong location. But we are going to write flood insurance based off of 6 perils of flooding that could impact a house. So this was the legacy system of what we used to write flood insurance, the rating variables. This is what was going to be used for risk rating 2.0. As you can see, the increase in rating variables has increased significantly. We are now going to take in consideration the distance to flooding source and type. And we do mean flooding source. We're not talking about a small tributary. We're talking about a river. We're talking about a lake, the coast, the Great Lakes, something like Pontchartrain, and up there in the northeast for the Great Lakes. We're talking about building occupancy. Okay, our primary concern at the National Flood Insurance Program is make sure your primary home is taken care of. So when you have 2, 3, 4 other homes, the glide path on those is going to be different. Your primary homes, by law, we are not allowed to raise flood insurance premiums more than 18% a year. That's what your flood insurance will increase if there is an increase for your full risk rate. If you experience a decrease, your decrease will automatically drop to where that is. All secondary homes, rental homes, or businesses will increase up to 25% for their glide path. The construction type is now being taken in consideration for the first time, and I have a whole slide dedicated to that, so I'm not going to talk too much. The foundation types, so important. Once again, I have slides that are going to break these down, so I'm not going to speak too much on them. But one of the things that's really important in changing is the first floor height. Under the legacy system, we ask for the base flood elevation, and we normally require an elevation certificate. Well, we have teamed up with several industry leading companies, CoreLogic, and we have devised a proprietary product, and it's called the first floor height tool. We have the capability of providing the first floor height for 80% of our book of business. Now, the first floor height is simply answering the question, how high is the first floor from the ground? And when I mean the ground, we're talking about the lowest adjacent grade. Now, your foundation touches the ground, okay? We're going to walk around that foundation until we find the lowest part. And now that's considered the leg. So we're just asking the question, how high is first floor from the leg? That's it. We're removing all the complexity of what was the old system. We're also going to be taking into consideration number of floors and prior claims. Now, like I said, please bear with me. I'm going to break this down one by one here coming forward. So under the old system, the flood risk was based off of one of 2 perils. And that was either riverine or coastal storm surge, okay? That was it, one of the 2. You were not ever charged for both of them. Now we have realized that a single structure can face multiple perils. And those perils could be specific to certain areas such as tsunami. If you're right on the coast, especially on the East Coast or the West Coast, more of an impact than tsunami than the coastal region or the Gulf Coast region where we have. But it is a peril that we have to take in consideration now. Coastal erosion is another one. Inland flood fluvial. This is a new one. This is rainfall. And unfortunately, we saw the devastating effect of rainfall during Hurricane Harvey when 52 inches of rain fell in this area. Devastating. Rainfall was not taken into consideration, or the data for the rainfall was not updated until recently, and it made significant changes to how flood insurance premiums are written. Now we have inland flood from riverine, which we have always had, and Great Lakes, and of course storm surge when you get closer to the areas. So if your home is impacted by these perils, they're added on. So how it works is we have what's called a risk rating engine, and insurance agents have access to this. They will input your home address. The address will be converted to latitude and longitude. That latitude and longitude will be pinged off of data sets. And one of those data sets will be the flooding peril. It will look at the flooding peril and see which one is added on. If more than one is added on, they will be added on top of other fees and surcharges for your final premium. If only one applies, then only one will be added on. So it really depends on the geographic location of your home. So what is changing? We're talking about FEMA source data. Flood insurance rate maps have been a primary tool under the legacy system. Now, they are still important products, and they will be used for compliance purposes. Don't forget, a community has joined the National Flood Insurance Program. They agreed to adopt and enforce regulations, but we will not be using firms for rating of flood insurance anymore. Now, remember, we're going to an individual risk assessment, okay? But the firms will still be published and still be provided to the community for compliance purposes. So additional data sets, this is really, really new for us. We have teamed up with a lot of industry-leading partners in catastrophic modeling. The catastrophic modeling, which are 3 of them, really make up the backbone of how flood insurance is written. And this is already being used in private industry. Like I said, we're 54 years behind the times. We're just now catching up. We have also incorporated other data sets from federal partners, such as Army Corps of Engineers levy data set, NOAA's coastal levees data sets, and multiple others to incorporate into risk rating 2.0. So this is not just a FEMA data only. We have taken the best information from all the federal agencies and incorporated them into our risk rating engine to provide us with the best risk assessment for every building in our book of business. So the broader range of flood frequencies. So we have started to realize that we had to understand the flooding frequencies, how often they're happening, how severe they're happening. Now, we can only go back so far because we have written records. So what we relied on is another industry model called the Monte Carlo model. And this is based off simulations. We have records based off 10,000 years, obviously not real, but based off of simulations. And the simulations provided us information where we can make the best assessments in areas across the country on the flood risk and the frequency of flood risk in these areas based off that modeling. It's really fantastic stuff. Okay, cost to rebuild. Now, cost to rebuild has only been used in a certain number of flood insurance policies under the legacy system. Often those that were apartment complexes, condominium, we call the RCBAP, residential condominium associated buildings. But to come in line with is being used industry practice right now, we are now going to incorporate replacement cost value and all of our flood insurance policies. So no more are we going to take in consideration depreciation. Before in the legacy system, if your structure was insured 80% or higher to include the garage, you would have been replacement cost value. If you were under that, you would have been actual cash value, and that means depreciation was taken in consideration. And although there's a lot of you who do maintain and upkeep your home, there are some that did not. So the depreciation impacted them a lot harder than others. Now, depreciation, if you take these really nice chairs we have in here, after 5 years, you pay $100 per chair. After 5 years and a lot of use, you're going to be able to get $25 for them on Facebook Marketplace. So that's what we mean by depreciation. So to change it and to make things more in line with industry practice, all of our insurance policies will now be based on replacement cost value, will also be known to cost to rebuild. Okay, so the rating variables, this is what we're going to break down. This is the meat and potatoes of why people are here. Distance to flooding source. Legacy methodology, as remember, we went over that, just had those few variables. We went over the 6 perils of flooding, and what we were referring to here, the distance to flooding source is going to automatically happen off a geolocation tool that was created for us. It happens automatically by algorithm. And it's really, really impressive how it works. You simply put in an address converted lat long, and it's pinged off all these data sets, including the geolocation tool. And it's going to ask questions like, where is this property? Is it in a watershed? If it's in a watershed, is it upstream or downstream? Is it in a coastal barrier island? Is it at some place of great concern? All these questions are going to be answered automatically by use of this risk rating engine and the algorithm. The building occupancy. So single family dwelling, it really doesn't matter to us if it's residential, mobile home, manufactured home, just a brick and stick home. The building occupancy is going to be important for your primary residence. Either it's your primary or non-primary. Don't forget, because of Homeowners Flood Insurance Affordability Act that passed in 2014, Congress limited the rate of flood insurance increase to not exceed 18%. So your primary homes, if you do experience an increase in a risk rating 2.0, will be capped at 18%. All others can go up to 25%. Construction type. For the first time ever, we are taking in consideration the construction type for flood insurance premiums. Now, why is this so important? Well, there's certain construction methods out there that don't bode very well during a flooding event. And there are some out there that all you do is take a water hose out there, you spray it down, you clean it off, and you're good to go. So we're going to have three types. We're going to have frame, masonry, and other. Frame is simply that. It's going to be a wood frame construction or a metal frame construction. Masonry is going to be some type of a brick, solid brick. It could be cinder block, just some type of rock type material. So anything else is going to be called other. Now, other will be rated the same as frame for right now. So in reality, we have really two rating methods, frame and masonry. But masonry has been proven to withstand flooding events and experience less damage. So therefore, if you have a masonry for the first floor, masonry type construction, you're going to have a lower flood insurance premium. Now, I say the first floor because that's often the floor that's going to experience the brunt of the flooding event, right? So if the first floor is masonry, then you want to do frame on the second and third, that's fine. We are concerned with the first floor that is going to experience the brunt of the flooding event will experience a lower flood insurance premium. Now, we know that there is a varied method of construction out there. And in the new flood insurance manual, we have tried to tie what type of construction method would be rated under what type of construction type. So the new flood insurance manual will help people to understand that. So currently, FEMA has over 80 different diagrams when we start talking about elevation certificate and foundation types. Excuse me while I take a drink. It's very confusing. It is absolutely confusing when you try to read these in the elevation certificates. We are changing that. Instead of the 80 diagrams, we are now going to have 6. Now, those 6 foundation types are going to be 3 that are not elevated. We have slab on grade, we have basement, and crawl space. The basement one is really important because basements used to be really difficult for rating purposes because the lowest floor used to include the basement. So that middle diagram, the lowest floor could be 5, 6, 7, 8 feet below the basement elevation, which would equate to a very significant flood insurance premium. While moving forward, the floors will only be counted on floors above ground for risk rating 2.0. And so the third one is crawl space. Now, we do have that 5 foot there for a reason. There is a load charge added on to anything with a crawl space over 5 feet because anything over 5 feet is tempted to turn that area that is supposed to be used for parking, access, and storage into additional living spaces or other type of spaces which are not allowed. So there will be, if it's higher than 5 foot crawl space, there will be additional charge on that. The other 3 foundation types are going to be elevated. Are elevated without enclosure on pier, post pile and pier, elevated with enclosure, post pile and pier, and elevated with enclosure, not post pile and pier. So these are going to be our 6 foundation types, and it's just important that we have tried really hard to remove the complexity of what was the legacy system and make it easier for agents and homeowners to understand, so best decisions can be made in regards to overall flood insurance premiums. Now, we do know that there are multiple different types of foundations out there. And once again, the flood insurance manual, with help of your agent, you'll be able to compare what construction type, what foundation type you actually have will then be tied to one of the 6 that we have in the new flood insurance manual. So this is the geolocation tool, right? What I am referring to. It's going to ping all this really cool information off of the distance to nearest flooding source, the ground and surrounding elevation, which is really important. People ask me, is elevating still going to be a benefit under risk rating 2.0? And I can't tell them enough. Yes, it is. Elevation under the old system was very important, just like protected by levee was very important. They are still important under risk rating 2.0, but you may not see the direct impact because of new variables, new perils added on. But the ground and surrounding elevation is really important. If homeowners are still looking to buy homes or looking to build, one of the most important decisions they can make is the location for that home. If they can pick some place that has a higher ground and surrounding elevation and then still build on pier, piles, and posts, their flood insurance premiums are going to reduce significantly than if they pick a lower lying area, especially now that we're taking rainfall into consideration. And so the geolocation tool is protected by levee. One of the good things about risk rating 2.0, under the old system, a levee had to be certified by the Army Corps of Engineers to be taken into consideration for a discount on flood insurance premium. Well, under risk rating 2.0, we have learned that there are a lot of levees out there that provide protection, but for some reason or the other are simply not certified by the Army Corps of Engineers. Well, we have decided that we're not going to require the certification anymore from the Army Corps of Engineers. If the levee has proven by engineering aspects that it provides protection, that protection will be taken into consideration on the flood insurance premium. So that is a benefit to a lot of people out there who are protected by levees that were not certified. And it's a very difficult process to get levees certified because the levee, building the levee is just part of the equation. There has to be a plan to maintain it, preventive maintenance and all the pumping equipment, all that is part of the levee system. So it's really difficult to get that type of certification. Okay, and so once again, the geolocation tool is going to answer questions about the watershed. Where is this structure in relation to that watershed? Upstream, downstream? Is it on a barrier island? Is it of other concern? Okay. First floor height. So elevations will be used in determining rates for all buildings. But what we are referring to here is the first floor height. FEMA now has the capability to provide this for a vast majority of our book of business. So therefore, elevation certificates will not be required to purchase flood insurance. Let me stress this point though. I stress for flood insurance. Elevation certificates are still required in communities for compliance to ensure the communities are enforcing their regulations. So elevation certificates will still be required for compliance, just not necessarily for insurance. But let me throw something out there. Elevation certificates have a lot of good information on there. And I'm happy that it's no longer a requirement, but an elevation certificate, if it is a feasible aspect for a homeowner to get, it is full of a lot of good information. We associate elevation certificate with the basement elevation and the lowest floor. But it's a way to confirm the flood or the panel, the suffix number, the panel date, lowest trace grade, highest trace grade, location, machinery. If it's enclosed, if it's properly vented, if it is vented, does it meet the 1 square inch for 1 square foot requirement for the flood venting? All that information is found on an elevation certificate. So if it's within the means, especially for post-construction elevation certificates, because even though we do have the capability to provide this information, everything has to be updated because we have to capture new construction as they complete. So if they have a post-construction elevation certificate, that could be a method to help us determine the first floor height until our system is caught up with it. So determining the first floor height, there will be 3 methods. And here's a diagram. Simply the first floor is from, that is what we're looking at for the first floor. See where the arrow is at. This is the first floor in relation to the lowest trace grade. That is what we're asking. How high is the first floor from the lowest trace grade? Very simple. Method 1 is going to be the tool. We have a first floor height tool that will provide a lot of this information. The second one will be based off FEMA assumptions. Now, FEMA assumptions are worst case scenario. Our actuaries determined that FEMA's assumptions will not exceed 2.5 feet. So even if you have structures elevated 9 feet, our assumptions will stop at 2.5. Therefore, the premium will not be accurate. The third method would be submittal of elevation certificate. I encourage this. I encourage homeowners to get an EC anyway, even though it's not required. It's a way to check our data. We're trying really hard to modernize and to provide the best data we can. But this is a good way to check us, making sure that our elevation matches and that we have the best rate. Now, if the elevation certificate does provide a different number and is more advantageous for the insured, we will take that information and give the insured the most advantageous rate that is in front of us. So the number of floors. This is really a good thing that the number of floors will no longer include basements. It's going to be very simple. One will be the first floor, second will be the third floor. We go for single family homes, 3+, condominiums, apartments, all the way up to 100+. The floors are going to correspond, which just makes it easier to understand. Number of floors will not include crawl spaces or enclosures as well. Once again, removing the complexity of what was the legacy system, making it easier for everyone to understand. This is this example of the number of floors. Third floor is going to equate to third floor on our premiums. Okay, prior claims. Prior claims is a big one, especially around the Harris County area that we're in now. Prior claims are a direct variable on how flood insurance premiums are written. Under risk rating 2.0, however, everyone is starting with a clean slate. Now, I'm not saying prior claims are being removed. They're just not being counted right now. Prior claims will stay in the background until you submit a first claim under risk rating 2.0. Then all claims will come back and then will be a variable on there. This is a way just to start everyone off easier. It's a little bit more complex of a system to try to bring prior claims back in all at one time. So our actuaries determined that everyone's going to start with a clean slate. Now, there may be some structures out there that have what's called a severe repetitive loss designation. They have experienced multiple claims. Now, their claims are also going to be put on the side, but they will still experience their SRL surcharge, which is 15%. Now, if they file a claim after risk rating 2.0, phase 2 goes into effect, or after they become a risk rating 2.0 policy, their surcharge will fall off, but all their prior claims, which would normally be very substantial, will come back into play. So I have a couple of diagrams to help me explain this a little bit easier for you. But first, let me explain what is a claim and what is not, what's excluded. So we have what's called the increased cost of compliance. Everyone pays a little bit extra for this, and it's up to additional $30,000 for structures who are not in compliance to help them come into compliance, because a lot of times those structures are going to be deemed substantially damaged by the community, and elevating a structure is very expensive nowadays, easily 6 figures. So this could be up to an additional $30,000 to help bring the structure into compliance. And claims without payment, claims closed without payments. Now that can come from any number of means. Oftentimes it's because the damage doesn't exceed the amount of the deductible. So therefore homeowners decide, let's not have that claim on there, it's not worth it. Or homeowners will initiate a claim, they're evacuating, they're starting the claim process because they're just under the impression they're going to come back to a lot of damage. Well, they come back very little damage, so claim closed without payment. So those are excluded. Those don't count as prior claims. One of the things risk rating 2.0 is also doing is we are implementing a 20-year rolling time period in which old claims will just basically fall off. Now this, once again, to remove the complexity and make it more in line with industry practice, the actuaries determined that 20 years is the best time for the claim data to be kept. So anything after 20 years will be fall off. So this example, let me move this one. So this example, we started the policy in 2003. First claim was September 1, 2007. 2011, we had claim number 2. 2021, a new pricing methodology, which is risk rating 2.0. 2024, claim 3. Total number of claims is 3, but if you look at that claim factor, it's 3 minus 1. So in the NFIP, you get your first one, it doesn't count against you. Okay, so it would be a factor of, you look at the October 1, 2027 renewal claim, total number of claims would be 2. But then we have claim number 1 falls off. So the variable will be 1. So at the 20-year period, the claim will fall off, and then that will count. You always have that 1 that's a freebie. So did I explain that good enough? I see some confused faces. No. So this is really nice because you get a flood loss history report every year. If you have a flood insurance policy, you get a report every year of the number of claims. Now, the claims are for the structure itself, not the owner. So if you've owned this house for 5-10 years, but it's flooded multiple times in the past, it will have all those claims on there. So some claims from the 70s. So now those are going to be falling off, making it easier to understand and have that proof or the loss record a little bit easier to understand. Okay, so what we are providing for you, we're providing the geographic variables used to provide the latitude and longitude for your home. This is where we're going to use that geolocation tool. Where are you? What factors are we going to take in consideration? We're providing the first floor height. We're also providing replacement cost value. And we also have an NFIP claims history report that we're giving you. So what can policyholders and agents provide and help, okay? So ground elevation. So remember I told you our geolocation tool is going to ping your location on a map, and we're going to look at the ground and surrounding elevation. If you have a survey that's stamped and sealed by a PE, and it shows that the ground elevations are different, once again, if it's more beneficial for you, we're going to incorporate that data into ours, and we're going to give you the better rate. So the first floor height tool, once again, if our data says one thing, but you provide a stamped and sealed elevation certificate that shows a better rate, we will accept that. Replacement cost value, if you have something that shows a different replacement cost value than what we have, once again, certified appraisal or something to that extent, we would take that. And NFIP claims history, we try our hardest to keep documents accurate. But we make mistakes, and sometimes there's changes. 911 addresses change a lot more than people realize, and street names change a lot. So sometimes claims get tied to houses which never experienced that claim to begin with. So they can reach out to me, and I will help untie those claims for them to make sure that they're being rated properly moving forward. So the homeowners and agents can actually provide a lot and impact the flood insurance premium significantly. Now, unfortunately, things that are not changing and still being added on are fees and surcharges. We have the reserve fund assessment fee, which is fully 18% of the premium. Now, unfortunately, I have seen this one fee alone raise flood insurance premiums significantly. Well, see, the thing is, we have to remember here that this is not part of the premium. This is separate from the premium. So it will look like the premium, the total annual pay amount is higher than the 18%, but the premium itself has stayed under that 18%. The fees and surcharges make it look like it's higher than that. So that reserve fund assessment fee is 18%. Then the FIA surcharge, Homeowners Flood Insurance Affordability Act, $25 for primary residents and $250 for all others. Federal policy fee did decrease. It went from $50 to $47, so save $3. And probation surcharge, community is not even, probation surcharge is for a community who is not enforcing regulations. And we have found them to be non-cooperative to try to get them back on track. We will put them on probation, and every policyholder in the community will experience a $50 surcharge on top of their fees. So this is a mock-up of what a declaration page is going to look like. Now, quotes are a little bit different. FEMA did not put a requirement for our WIO partners on what information has to be in a quote. I have seen quotes that have been very informative from some companies, breaking it down just like we see here on this mock declaration page. And I have seen some quotes that have very little. It has just, if you have this deductible, this is your premium based on the rating engine. But this is what's going to be a requirement for the WIOs to provide on your declaration page. If you'll note that there is a number that says full risk premium, okay? The full risk premium for the first time is going to be identified under risk rating 2.0. Under the legacy system, when FIA was passed in 2014, Congress said we will increase flood insurance premiums no less than 5%, no more than 18%, until they hit their full risk rate. But the problem was no one ever mentioned what is the full risk rate. It was never identified. So these rate increases were going to continue forever. So under risk rating 2.0, we decided that, hey, we need to be able to tell these people what is their full risk rate. So we have. Your declaration page will have that full risk premium. Then underneath that, you'll see your statutory discounts, which we will talk about here in a few minutes, adjusted premium, but you'll look and down there and you'll see your total annual payment. So under risk rating 2.0, if your total annual payment is lower than your full risk premium, you will experience an 18% glide path until you hit your full risk premium. If your total annual payment is higher than your full risk premium, then you will experience immediate decrease to your full risk premium, and then that will be it. So one of the things I'm happy to say about, I know increases are not something to look forward to, but under risk rating 2.0, the increases are finally coming to an end when you hit full risk premiums. Remember, as I mentioned, under the legacy system, that they would have continued. This past year would have been a 15% increase under the legacy system, followed by another increase year after year after year. It would have increased. This year, for and I'm using numbers for Louisiana because I'm speaking over there tomorrow. There's a community that has a 37% decrease under risk rating 2.0, 67%, 60% increase. But under the legacy system, there was a 99% increase across the board. So risk rating 2.0 is helping some. Not a great deal, I admit that, but it's helping some. But we are finally getting to the point where the premiums will no longer increase unless there's a substantial change in the rating variables. Well, what could that be? Well, if you add on a wing to your home, you significantly change the replacement cost value of your home, that's going to be taken into consideration. Or if the community does a massive flood control project, they change the ground and surrounding elevations, that could have an impact. Now, there may be some administrative changes to the fees and surcharges, but remember that is not part of the premium process. So risk rating 2.0, when you finally realize your full risk rate, that's when your premium will stop increasing. And for some people, it will be a couple of years until they hit the full risk premium. And some, it might take 10 years, 15 years for them to go from their starting point to their full risk premium. So what is changing under the statutory discounts and mitigation credits? So as I mentioned earlier, there are some statutory programs that we had to keep into risk rating 2.0, the pre-firm, newly mapped, and some A99 and AAR programs. Those are levy programs. Those are staying in place, but they're going to be rated a little bit differently. The percentage is going to be changed up, and they're going to be reviewed annually at FEMA headquarters. Policy will transition upon its true risk rate. For those of you who are going to be implemented to risk rating 2.0 after phase 2, which is April, will be upon your renewal. And in general, this is really important. Under the legacy system, we had a lot of leeway in helping people who exceeded a 30-day grace period to pay their flood insurance premium. You have your due date. We had a 30-day window in which we allowed you to pay your premium and still maintain your existing flood insurance policy. And then we had an additional 30 or 60 to 90 days in which we still got people in under special circumstances. We no longer have that capability. If a policy exceeds its 30-day grace period, it will automatically become a lapsed policy, and the policyholder will start the process anew, which would incur a 30-day wait and have them come under full risk rate right off the beginning. So there will be no longer will they have that incremental increase to help. I mean, the increase, it's an increase, and we don't like increases, but this increases is something that can be planned for and can help you understand where your premiums are going to be year after year with that 18% increase. So leaving and coming back in at a full risk rate, you come back in at the maximum allowed. There is no more increase anymore. So it's going to be very substantial if a policy is lapsed. So community rating system is some of the changes are happening here. I'm pretty excited about this. This community is a class 7 CRS, and the CRS program has been around for a while, and it normally awards provides a percentage discount for structures that reside inside of the special flood hazard area. So those of you who lived in X zones and you had a PRP, you were not able to get this discount. In your community, it's a 15% discount. So you were not able to get 15%, class 7. You were not able to get this discount. Now, with the changes under risk rating 2.0, this CRS discount is now going to be available for every homeowner in the jurisdictional boundaries of your community. So there is one small caveat. If you are outside of the special flood hazard area, you have to be at full risk rate. When you're at full risk rate, then you'll be eligible for any of the statutory and construction discounts, plus the 15% discount for the CRS program. So the community is working really hard. The CRS program is not easy. The fact that it's a 7 means they worked really hard to get this discount. So it's a really big thing that is being offered, being available to the constituents of this city. So I kind of talked on that here for a second. The CRS program has a discounts of 5 to 45%. We're at 15% for this community. The post-firm minus rated policies will be excluded from CRS. So what that means is if we have structures that are not compliant with the community regulations, that structure itself won't be eligible for the CRS percentage discount. So as long as the structure was compliance, built-in compliance inside of the special flood hazard area, it will be eligible for the percentage discount. And structures outside of the special flood hazard area, they have no building regulations. So they'll be eligible once they hit full risk rate. So here's a little graph to kind of help understand. I have two columns here. One of them is legacy pricing methodology, and the other one is the new pricing methodology. So think of it as risk rating 1.0, risk rating 2.0. So we have structure one. Structure one is inside of the special flood hazard area. Current, it's a standard A-zone policy and was built in compliance. So under the old system, it was eligible for a 30% discount. And under the new system, under risk rating 2.0, it will remain under the 30% discount. So structure two is outside of the special flood hazard area. It was an X zone, but for some reason, it was not eligible for a preferred risk policy, okay? So the maximum discount it could get was 10%. But under risk rating 2.0, once the structure has hit full risk rate, it will now receive the full 30% discount in this example. Structure three is outside of the special flood hazard area. The current policy is a preferred risk policy. As you'll see under the legacy system, there's no discount because preferred risk policy was not eligible for the CRS discount. So it received none. But under new pricing methodology, since preferred risk policies are going away, once this policy is at full risk rate, it will also be eligible for the full 30% discount from the CRS rating. Structure four is inside of the special flood hazard area. It's new business, so it's coming in under full risk rate, but you'll notice that it's not built in compliance. Since it's not built in compliance, it's not eligible for the CRS discount, so no discount. And structure five is outside of the special flood hazard area. New pricing methodology, it's new business coming in full risk rate. Built-in compliance is non-applicable since it's outside of the special flood hazard area. But since it is new business, it's coming in full risk rate. And since it's at full risk rate, it'll be immediately available, eligible for the 30% discount the CRS offers. Now, this is an example, and these numbers are notional, but we're trying to just show you how it's going to work under CRS. Okay, machinery and equipment. This is really a good thing for a lot of homeowners who mitigated their homes by elevating them on piers, piles, and posts. This will not have a big impact on homes that are slab on grade, unfortunately. But we are going to offer a 5% machinery and equipment discount. What we are meaning by this, M&O, machinery and equipment, is a discount that is either all or none. So either all the machinery equipment is on the appropriate floor or you don't get it. So what we mean by appropriate floor, and I'm going to explain to you why slab on grades may not be eligible for this. Now, there may be some slab on grade structures that have their air conditioner or their water heaters in the attic, their HVAC main systems in the attic minus the compressors. And that's fine if you have a building only policy. But when you have a content policy, we also require other machinery and equipment to be on the appropriate floor. So we start talking about washer and dryer, dishwasher, not practical to have those in the attic. So the machinery equipment is not likely to be extended to slab on grade type of structures. But machinery and equipment is more likely going to be achieved by houses that are elevated, pier, pylons, and beams. The diagram in which is found in the flood insurance manual will go into detail on what is the appropriate floor based on the foundation type. So elevated structures are going to be really, I won't say easily, but more opportune for this because the appropriate floor is often going to be higher than the ground level or the next higher floor than the ground. More achievable for that 5% discount. Now it's only 5%, so in the grand scheme, it may not be a whole lot for these slab on grades. But one of the things I like about risk rating 2.0 is these discounts compound on top of each other. We talk about the construction discount already for the masonry versus wood. That's a discount right there. That's going to compound with your machinery and equipment discount, right? Then we're moving. Okay, so here's a little bit of an example for the first floor. Slab on grade, non-elevated. The appropriate floor for the machine equipment is going to be the attic. That's not practical for all the machine equipment. For the basement, non-elevated, elevated the next of the floor above the basement or higher. So that could be the first floor. Crawl space, including non-elevated, is going to be the first floor. So you're starting to see how it could be practical for some elevated structures, but unlikely for slab on grade type. So this is found in the flood insurance manual, and you'll be able to determine which appropriate floor is needed for this machinery and equipment discount. But another thing that is also being considered or provided under risk rating 2.0 is a discount for flood vents. Now, flood vents, once again, was only available for homes that were inside of the special flood hazard area. Now, if you have an elevated structure and you have an enclosure, it's a requirement for floodplain management that you have the proper flood venting to allow the unimpeded flow of water to prevent hydrostatic pressure building up and imploding your house. It's already there. It's a requirement. You're going to receive anywhere from a 3 to 27% discount based on the square footage of your enclosed area. Once again, this is going to be compounded on top of your machinery and equipment discount, on top of your construction discount. So you see how these discounts can add up. But these flood venting discounts are now going to be available for every house in the jurisdictional boundaries of the community. So once again, we are incentivizing mitigation measures in areas that have been known as the X zones, or the area of minimal flooding. Now, floodproofing is something that we still can do for, in FEMA's eyes, you're either a residence or a non-residence. Your non-residents are going to be your businesses, your box stores, your hospitals, your car dealerships. So non-residential can drive floodproof, and they have to meet the architectural and engineer designs to be allowed. And that's something that we are still taking into consideration under risk rating 2.0. So what is changing, what is going away? We already talked about grandfathering. There's not a whole lot in our book of business. They have slowly been dwindled out simply because of rate increases. Remember, the good thing about grandfather policies is that their starting point under risk rating 2.0 is likely going to be a lot lower than a standard. So the thing about grandfathering is we are still going to allow the assignment of policies. What we mean by that is you can, if you have an intent to sell your home and you have a grandfather policy, you can assign that policy over to a prospective buyer, making your house a little bit more marketable. Once again, you're still going to experience that 18% increase, but it's going to be a lot slower of a rate. We're doing away with a couple things. We talked about preferred risk policies. We are transitioning to a more individual risk assessment for every building in our book of business. That means we are doing away with the PRP product. The mortgage portfolio protection program was a way for lenders to put force-placed policies on homeowners who did not meet their obligation to purchase flood insurance. But we had about 100 of those in our book of business. So just to remove the complexity, we're getting rid of that program. And the SRG, the specific rating guidelines. When we had unique structures, or we had structures that were several feet below the base flood elevation, we would turn to this SRG guidebook to help determine the rates. Well, we have found the engine to be very accurate, and to the point where we no longer need this special rating guidebook. So we are doing away with that as well. But what is not changing? Mandatory purchase requirement of flood insurance is still staying in place. So what we mean by that is there is a law on the books that if a mortgage is touched by federal dollars, and federal dollars I mean Fannie Mae, Freddie Mac, VA, HUD, all those are conventional loans touched by federal dollars, the mandatory purchase of flood insurance is required if the home is in the special flood hazard area. So remember, I mentioned the firms are not being used to write flood insurance. They still will be used to determine the location of the home. If it's inside of the special flood hazard area, mandatory purchase of flood insurance will still apply. Floodplain management. Community compliance will still use the flood insurance rate maps to ensure compliance with new development and any changes to existing structures inside of the special flood hazard areas. They will still be taken into consideration for letter of map changes. Now, letter of map changes used to be a great way to help people reduce flood insurance premiums, especially if they wanted to submit what was called a letter of map amendment or a letter of map revision based on fill. Now, these are still great tools, but they won't have the impact on flood insurance that they once had. What they can still do is remove this structure from the special flood hazard area if that structure meets the eligibility requirements. So that can remove any mandatory purchase requirement, but since we are transitioning to individual risk assessment, it won't have the impact on flood insurance as it once did, but still very beneficial. Statutory caps are not changing. I have said it several times, and I say things several times because I just think they're important for people to understand. We cannot raise flood insurance premiums more than 18% a year. And so that statutory cap is still staying in place, as long with the maximum coverage limits. So we have a statutory cap of $250,000 for a building, for single-family homes, residential structures, and $100,000 content. For businesses, we have $500,000 building, $500,000 content. The increased cost of compliance is still up to $30,000. There may be some legislation on the hill to increase these, but as of right now, they are remaining as they are. The underwriting forums by far and large have not changed. There have been some small changes to incorporate risk rating 2.0 guidelines, but are staying the same. And that's really important because we have a lot of FEMA certified adjusters out there and underwriters out there who are used to these type of forms. The main policy forms are the dwelling, which is for your building, the general property is for your content, and RC BAP, residential condominium building association policies are not changing. I've already talked about this, the assignment of a policy. People may be familiar with the term of rollover. You can roll over this policy to a new owner. That's still in place, should be done at closing when all the documentation is available from the existing policyholder to the new policyholder. Your agents should be knowledgeable on this and be able to guide you on how to assign an existing policy to a new policy. So the transition of current policies, we're implementing phase 2 of risk rating 2.0 April of this year. While everyone's asking what happened to phase 1. Phase 1 was implemented October of last year, and that was for new business and for anyone who has a renewal between October and April of this year. They had an option. They could look at a quote for the legacy system and a quote for risk rating 2.0, and they can pick whatever one was most advantageous for them. As of April of 1st of this year, we are implementing phase 2. So that means our entire book of business, remember all 5 million of our policies, will transition to risk rating 2.0 upon their renewal. Just kind of talked about that here for a second. So this is a nationwide numbers. On average, we expect 1 million policies to have a decrease across the country. But you can see that number, that 66% in the blue, that's a $0 to $10 a month increase. So about 120 a year. Now, this is just for the first year. Don't forget, there's an 18% glide path increase until they hit full risk rate. We could not identify, we did not have the capability of determining year after year after year because each person is going to start off at a different point. But this was on average for the first year. You can see we do have about 11% that are going to experience a little bit higher than that. But for single family homes, we are seeing a cap. Believe it or not, we do have some single family homes that are exceeding $30,000 a year in flood insurance premiums. It's very substantial. Under risk rating 2.0, there won't be a single family home that has a flood insurance policy over $12,125. Still substantial, but far less than the $30,000 out there now. So risk rating 2.0, here are some resources for you. This first one, the risk rating 2.0 equity in action website has been updated. Halfway down or a link, it's called technical documents. There is a premium calculation worksheet. Now those numbers are notional, but it gives you a really good idea of how these numbers are used on here. And there's also updated data on levies. It won't have a premium breakdown of the levies, but it will tell you how levies are being incorporated into risk rating 2.0. Now the equity in action fact sheet is a 6-page fact sheet. It kind of breaks down what I just said. When we went over, obviously not in a great of detail, but it just touches on some of the major talking points. Risk rating 2.0 is needed. It has been something that's been in the works for the past 5 years. I really wish we would have made major changes along the road of the NFIP. Once again, 54 years without major changes has put us in the position we are now. And now that we are making changes, we are seeing that we have been, once again, lower valued homes subsidizing higher valued homes. We have insured flood, basically incentivized living in high risk flood areas for years. And it's time for us to correct a lot of our mistakes, and risk rating 2.0 is our avenue for this. So with that being said, thank you very much. I will open this up for questions and answers now, if we have any on Zoom. We don't have any questions on Zoom. Anything in the room? The flood insurance manual? It- Okay, the flood insurance manual is open source. You can do a search on any search engine, and you want risk rating, or you want the flood insurance manual for 2022. And that's a very technical document. That's more for insurance agents, but it's open source, so the public in general can have access to it as well. There's the resources, Risk Rating 2.0 Equity Action is a really good source. It provides a path for our customers to understand Risk Rating 2.0. And I'm not sure what book you mean.
When you get your renewal, they send you the required supplements in the mail each year. The little booklet, when you sign your acknowledgement that you.
Okay. So that coverage booklet is it's going to be so flood insurance is a single peril policy. So what they're doing is they're sending you a booklet on what is covered for your single peril policies. For example, flood insurance is only going to cover flood insurance. It's not going to cover damages to your home that are not done by flood. So that's going to break down your coverage in general.
Mentioned the flood insurance manual. Is that the same as when you find the FEMA action website?
No, sir. Those links were Risk Rating 2.0 specific. The flood insurance manual covers all of flood insurance, how to write, reasons for cancellation. It goes into great depth. It's really thick manual. I'm sorry, sir.
You're trying to figure out what your rates are likely to be.
You're not going to be able to. Under the, of course.
And so from what I've seen, being close to the area, most of what you was prior was previously done as a PRP for risk policy and the Excel. Those policies were $570 a year. That's right. Is that what you guys had? Well, then if you were in the 80s, it was more expensive. But with risk rating 2.0, I've seen a range from like $1,000 to $3,000.
Right now, I'm paying for it.
Okay.
Yeah.
So what I'm saying was with risk rating 2.0, the homes in that area, and the reason why I say there's a range is like, the presenter said, it depends on the replacement cost of your home, the construction material in your home, things like that. So the range of prices I've seen for this neighborhood is $1,000 to $3,500.
So my question with that is, has FEMA model come and people are doing else?
No.
But the realization that, especially in the Houston area, my insurance is not, there's a low percentage of the population that has flood insurance. That they were saying during Harvey. I guess my concern is the unintended consequences of it, like going to the more risk rating, that it's just going to drive more people not get flood insurance unless they're required.
So there is a big difference. First, let me touch on your question. Licensed agents are the only one who have access to the engine to provide quotes. Even I don't as a FEMA representative. So if you want to know your flood insurance, your quotes, reach out to an agent and have multiple quotes. But they're the only ones who could tell you how much your flood insurance is going to increase. Now, I do encourage multiple quotes, not simply because you're shopping for price, but you're shopping for knowledge and experience. If they make a mistake on your quote, you won't know it. So find someone who knows what they're talking about, get a quote. Yes, I'll jump to that one in a second. And your question, I'm sorry, ma'am?
It was how many people are you?
Yes.
with the flood insurance?
Yeah, you're absolutely right. So PRP is going away. We had a lot of PRPs. They made up almost 50% of our book of business. And we understand that some people are not going to renew when their rates increase significantly. But we have to understand that under the legacy system, it was not sustainable anymore. We were not charging.
I understand
Yeah.
that.
Well,
You're not gonna have enough people to pay out.
okay, so, and this,
Okay, so, but you answered the question.
Yeah.
You
well,
guys haven't modeled it yet.
also remember that 33% of our claims have been from areas outside of the special flood hazard area, where homes are not paying rates based on their risk, but of their location. So if they do decide to cancel, we will have less claims in those areas. I'm not saying that it's a good thing. I hope people understand the difference between flood insurance and disaster assistance. Flood insurance is a sure way of helping you to rebuild your home. Disaster assistance, the average disaster payout for Hurricane Harvey was $4,400. So if they choose to cancel their flood insurance, they'll be relying on disaster assistance. Now, I know the rate increase is going to be a hard pill to swallow, but we were talking about a flooding event that has increased in severity and frequency over the years. So yes, but we do understand that, and that was something of but still a great concern for us. So thank you. And Mr. Kent, there is a construction discount and well as a construction for elevation. So if you were to elevate the structure in pure pylon posts, I'm sorry, the question is, does it make a difference if pylons on an elevated house are of wood or concrete? So if you have it on wood, you're still going to get a construction discount because it's elevated on pure pylon post. But if you were to elevate it on concrete and the lowest floor is also masonry, you will receive a greater discount, if that makes sense. We are concerned with the piers, pylons, and post, as well as the first floor. That's going to experience the brunt of the flooding event. So if those are masonry product, your premium is going to be lower. It may not be a significant difference, but it will be lower. Yes, sir.
In determining the elevation of the first floor, that's the first floor of the living area. If your garage is at a lower level, does that become your first floor?
No, your living area, your first floor. Yep, we have changed our foundation types to make it very easy. Before it would be, okay, is it attached to garage? Is it flood vented? So now it's the first floor of the home.
The other thing you mentioned about compliance, if your house is compliant when built, always compliant, even though the rules might have changed. Is that right?
As long as you are not under the umbrella of substantial improvement. So substantial improvement means that you have made improvements that exceed 50% of fair market value, or you're deemed substantially damaged by any event, which means your house has experienced damage 50% of fair market value. Yes, ma'am.
I have a question going back to the slide where you were talking about replacement cost value being one of the rating factors. You said something about 80% coverage. My understanding is that the home's insured for less than 80% RCP, then the claim settlement would be ACP, actual cash value.
It was under the legacy system.
And so what is it? So now, if they insure the home for 79% or less, the claim settlement is still replacement cost?
Nope, it's all replacement cost now. There's no longer going to take out depreciation. It's all based on replacement cost value.
Yeah,
I'm
so
sorry?
if they insure the home,
But we're not going off the 80% anymore. It's just either it's all replacement cost value. We're not going to have that criteria up to 80%
I'm just
anymore.
saying that, so it's taken away. If they
Yes.
insure the house for 79% or less, it's still gonna be replacement cost.
Yes.
coverage.
I'm sorry, misunderstood your question. You're absolutely right. Doesn't matter anymore. It's all going to be replacement cost value.
That's good to know.
Yes, ma'am.
When you talk about replacement cost, you're not talking about the second story, you're talking about the first.
Oh, yes, ma'am. We're talking about the cost of the entire home. You're absolutely right. And the reason we are taking this in consideration is for twofold. One, partial claims are very, they impact us very significantly. And partial claims where, you have a higher valued home, costs $600,000 replacement cost value. It's going to be very easy, even though the entire top part of that home may not have experienced water, the bottom part of that home can very easily exceed the $250,000 statutory cap. So the homes that have higher replacement cost value, it's going to be easy for them to max out. Well, you have homes that have lower replacement cost value, they're not going to experience much damage or cost as much to repair, lower cost value.
So what do they use for the number they use for the
So we provide a replacement cost value, but the homeowners can submit any type of additional data such as an appraisal or tax suppressor, appraisers. Okay, we're not, under the NFIP, we are not concerned with the land. We are only concerned with the house itself. They would have to, yes, but you would you would have to subtract the property from the structure itself.
Structure value. The problem with replacement costs is take the total property value.
They're not taking from total, they're taking only.
I understand that. So let's just say the total is $1.5 million. The land was $1 million. You got a $500,000 by default structure. It's probably going to cost you $700,000 to replace it in reality. You can't buy true replacement insurance.
Well, that's why it's called replacement cost. Well, and that's why I think I'm a little confused why you said appraisal value, because appraisal value isn't true replacement
Mhm.
cost. It's a different value of the home. It's replacement cost is.
But they can submit these additional documents for
Yeah,
review.
replacement cost
Yeah.
is how much is it per square foot to rebuild a 5,000 square foot, 2-story home made of brick with.
But I think I heard that's capped at
The coverage is capped at
$200,000, would not cover the majority of homes.
Well, they can get secondary lines of coverage. They can go in private sector and cover what else they feel that is necessary for their home. We are not allowed to exceed 250,000. Now, there is a bunch of legislation on the Hill. It's being kicked down the can. The can has been kicked down the road, one administration after the other. But my understanding, there are several bills on the Hill to, for one, provide a means of affordability, which we can't take in consideration. We have no way of doing a means test for affordability. And two, increasing the coverage amounts. Right now, it's statutory capped at 250,000 for single family homes for the building, 100,000 for content. We would love to increase that, but we can't until Congress approves that. So secondary lines of coverage are a way of people to providing more additional coverage on top of what we have.
So would that mean that when policies are being evaluated on the replacement costs, that is also capped at 250? So it
No.
doesn't matter based on the cut, even though my neighbor that has $1 million home, they're gonna pay more for $1 million home to get 250. Mine could be appraised at 250 and I'm gonna get 200.
You get the same amount of coverage, but the premium will be higher for the house that has the higher replacement cost value.
Let's say the 250,000, both homes are 1-story, and they each get 6 inches of water. There's going to be more damage in the $1 million home, 6 inches, than in the 250,000. The replacement cost of the damage is higher than $1 million home.
So the $1 million home is going to be maxed out a lot faster than the house valued at 200,000. And that's still partial. Well, to them, it's partial claim because a lot of their house may not have experienced damage, but to us, it's partial claim, and it's really impacting the way we intake premiums and the way we pay out claims. We have authority to borrow money from the Treasury, but we're over $20.5 billion in debt, and we're an agency that we don't get funding from Congress to pay back this amount of money. So I really don't know how we'll pay that.
Question about the increased cost of compliance. You said that it's an additional $30,000.
Up to, it's important.
Up to an additional 30,000. But my understanding, unless it's changed for the risk rating 2.0, was that the 30,000 is included in your building coverage?
No. So the up to $30,000 for the increased cost compliance is an up to additional 30,000 as long as you do not exceed the statutory cap of 250,000.
So if someone insures their home for 100,000, then they can get an additional up to 30,000 for ICP. But if they're maxed out at building limits of 250, then the ICP would have to follow.
Would not be eligible for it because they're already at the statutory cap. Yes.
I'd like to ask these guys a question, that maybe you can answer. You talked about elevations where there are break points. I know you said that the mapping of the floodplain on the map is sort of passé, but if we're speaking of that, if our new construction is 2 feet above that, is that at your preferred level, or are you 2.5, or are you 3, or what?
Okay, so elevation of the structure is still gonna be important, but I think what's gonna add on more is the ground and surrounding elevation you're gonna build on with addition of elevating the structure 2-3 feet. You're gonna get the most bang for your buck doing that.
You aware of what that rate point is?
I believe that's the maximum where you could get most credit is 3 feet.
So under the old system, you would receive the maximum benefit of 3 feet. Anything above that, you would still receive a discount, but not as substantial. The thing about risk rating 2.0 is I don't have those talking points or visual aids we did before. And I'll tell you why. Under the old system, it was very easy to look at the 3 variables. And I can tell you, okay, if you elevate 1 foot, this is how much your flood insurance is going to be. I can't do that now because I need to know all these new variables, which I don't have. I don't know your ground surrounding elevation. I don't know your first floor height. I don't know your construction method. I need all those are self-reporting between you and agents.
So you can get some benefit at 1 foot, bigger benefit at 2 feet, maximum benefit at 3 feet.
Yes, you're still going to receive a maximum. There is still going to be a substantial benefit of elevating your homes. I just can't tell you 1, 2, or 3 feet anymore because there's so many other variables now being added on.
Should we be contemplating elevating our air conditioner compressors? The house itself, everything, all the mechanicals in the house are gonna be consistent with the ground floor level. But if our compressor is sitting on the ground,
I would, and I'll tell you why.
no, it's flat hole.
So the compressor is outside on the small slab separate.
Equipment having a discount if it was elevated.
Well, there are going to be some exceptions for the compressors. We're talking about the main units itself. But I would still do that because the compressors can cost anywhere between $3,000 to $5,000, right? So if if they flood and you file a claim on that, if you do that twice in 10 years, you can be put on a repetitive loss.
What is the rate point? Is that the same as the?
There's not one for that unit. You just want to mitigate it, protect it. The machinery and equipment is not going to have a big impact. The machinery and equipment discount is going to apply for all the machinery and equipment inside the house. It's going to be excluding the compressor. So you still want to elevate that to protect it because it can have an impact on your flood insurance.
Flood insurance perspective, it doesn't matter.
Okay. Yes.
So the compressor doesn't count, but the AC inside.
The compressor excluded for the AC and for the heaters are excluded for the compressor. Flood insurance manual, yeah. But you still want to mitigate those. You still want to elevate them.
So after April, we'll find out what our increase will be, right?
I would encourage you to contact your agent and start asking for quotes now. You don't have to wait until April. They won't be able to write a new.
You've got 5 agents that are writing these policies. They're all gonna be priced the same. Okay?
The reason I ask you to get 3 quotes is not because you're price shopping. It's because you're looking for someone knowledgeable and experienced.
What's that experience?
Or you're going to be able to tell when you talk to them if they have.
What's that gonna give me if they're writing a policy on the same parameters?
Not only that, but if you ever have to submit a claim, you want someone who knows what they're doing instead of someone who's.
I mean, because, you know, when I was with flood insurance, I worked at the state farm office. And you know, flood insurance is the same. And then I started seeing policies where. But they didn't know that they could request a client to get an elevation. They know they could go back 1 year and request a refund. They didn't know anything. And so that's not like, oh, this is what I'm gonna do. So,
Have an agent in high court. I don't know.
Your policy has probably been on auto renew for years, but I would find you get a letter every year, your declaration page, flood loss history. Your deck page has your agent on there. It has the
Yeah, I
agent
know,
name,
I know.
agent name and contact information.
But you can't use change.
You can, but you'd want to wait until your renewal period.
Oh, okay.
if it's an
With my paper.
Yeah, just find the agent you want, just do a transfer of business at your renewal, and you can do that.
Current policy shows me as being in area X and current zone AE.
So that's, yeah. You can't be an X and an AE at the same time.
He has a standard policy, it's not preferred.
Okay, so you have a standard.
USAA.
No more questions on Zoom?
Yeah, so because you have a grandfather policy where you were in the X zone, that changed, you became grandfathered into the X zone, but it may have been more beneficial get an elevation certificate and rate it as an AE policy and see if it would have been.
See, grandfathering and pre-firmed are all based on assumptions. They're based on unknown data. Oh, okay. Okay.
Yeah, I mean, for a lot of people it is.
Yeah.
So what that means is when you put it, well, right now, like with risk rating 2.0, the zone isn't the main factor anymore. So I know people were buying homes in the X zone and they're shocked that the insurance was $1,700. They were expecting $500.
Well, but when you started out, it was like $25.
Then they remapped that. That property did not flood in Allison, it did not flood in Harbor, and yet that's still a.
Yeah, but we understand that. At least I do. I understand that sometimes, areas just have not experienced a 1% annual event. It can happen all around them, and it can happen multiple times. Houston has experienced several 1% annual events multiple times a year. And some areas, for some reason, they've just been spared, not experienced. But our mapping is not based on, our mapping is based on a storm event exceeding the 1%. So.
We're not riverine, we're from ditch, doesn't count as a river.
Does the bayou count as a flooding source, Great Bayou?
If it's big enough, yes, it'll be a flooding. So I'm not familiar with the area around here.
It's one of the bayous, so it's pretty much where most of the flooding centers from, and a lot of us.
So chances are, yes, that would be considered one of the flooding sources. What we mean by distance of flooding source, we don't mean like a small creek running in your backyard or a little, detention area here. We mean something of significance.
I wonder,
Thank you.
My pleasure. My contact information is available. If you have any questions that we didn't get to today, don't hesitate to get my email address, and I will do my best to answer any questions you have. Thank you very much.